In this video, we will be delving into the latest global developments across the fields of world affairs, international relations, and technology. One of the most pressing issues we will be exploring in detail is the looming risk of a debt default in the United States, which has escalated dramatically in the aftermath of the banking crisis. The potential threat of a U.S. debt default has become a significant concern for global investors, with reports indicating that since the expiration of the U.S. debt ceiling of $31.4 trillion in January, U.S. Treasury Secretary Janet Yellen has issued repeated warnings that the U.S. may run out of funds by June, leading to a debt default and triggering an economic and financial disaster in the U.S. As a result, the markets have bet heavily against the risk of a U.S. sovereign default, with the latest data revealing that the one-year credit default swap for the U.S. has reached its highest level in 10 years. Investors are now paying as much as $9,600 in insurance premiums per year for every $1 million of U.S. debt, surpassing levels seen in 2011 and 2013, and 7 times higher than earlier this year. As the deadline approaches, the probability of the U.S. defaulting on its debt is predicted to increase sevenfold. At the same time, concerns have been raised over Switzerland's financial reputation, with some international investors filing a formal appeal against the Swiss government's financial regulatory agency in the Federal Administrative Court in St. Gallen on April 18th. They contend that the Swiss Financial Market Supervisory Authority unilaterally announced the write-off of about $17.3 billion of Credit Suisse's additional Tier 1 capital bonds assets during the acquisition process of Credit Suisse by UBS, resulting in significant losses for international investors. These appellants argue that Switzerland's default behavior seriously violates the country's long-standing concept of protecting private property, and the financial concept previously promoted by Switzerland is equivalent to international financial fraud, which infringes on the property rights of global investors. The total assets involved in this appeal amount to about 4.5 billion Swiss francs, equivalent to $5 billion. Should the Swiss government regulatory agency lose, it would have a severe impact on the reputation of the Swiss Financial Market Supervisory Authority and Switzerland as a financial center. Reports indicate that U.S., Singaporean, and Japanese investors have all initiated asset claims against the Swiss government in different ways. At least 80 bondholders in Singapore are negotiating with the Swiss government over suing it, arguing that the Swiss write-off of bonds violated the trade agreement previously signed between Singapore and European countries, including Switzerland. Some U.S. investors have accused Credit Suisse of failing to disclose its massive customer outflows and internal control deficiencies. The fact that the Swiss regulatory agency announced the write-off of the relevant bonds 3 days ahead of schedule suggests that some Wall Street insiders may have detected the risk of default in Switzerland. This indicates a certain degree of correlation between U.S. and European capital and even the possibility of insider trading causing significant losses for Asian buyers. Some analysts believe that this is a manifestation of the performance of U.S. and European financial oligarchs as well as top bankers who can manipulate the U.S. dollar printing press collectively, sharing global investors. In addition to these issues, U.S. Treasury Secretary Yellen has sounded the alarm that a failure to raise the debt limit could cause irreparable damage to the U.S. economy and the world at large. Recent reports indicate that the U.S. and other Western countries have frozen over $300 billion in foreign currency assets held by the Russian central bank due to sanctions. Private property rights have long been a fundamental principle of American democracy, but recent events have raised concerns about the U.S. government's commitment to this principle, particularly in its practice of confiscating assets belonging to central banks and related entities of other countries. This is not a new phenomenon, as the U.S. has seized assets from various countries since the 20th century, damaging the credibility of the Western financial system and raising questions about the stability of currencies such as the U.S. dollar, Swiss franc, and euro. Recent events, including the Swiss debt collection incident and the potential risk of U.S. debt default, have compounded these concerns. As a result, experts are suggesting that the U.S. dollar and euro may no longer be the dominant international currencies in the future, with many countries exploring alternative currencies such as the renminbi or Indian rupee and diversifying their reserves by acquiring gold or establishing their own payment systems. Gold has become an increasingly popular alternative to traditional currencies because it is a tangible asset that cannot be created out of thin air like paper money. China's central bank has been increasing its gold reserves in recent years, with China importing 166 tons of gold in February 2023, up from 76 tons in January. Some analysts believe that China may be considering selling off its U.S. treasuries and increasing its gold reserves even further to maintain its reserve currency status in the short term. Some in the U.S. Congress and Wall Street have recommended that the Treasury Department tap into its gold reserves to service its debt in case of funding depletion. However, this would require close monitoring to maintain global creditworthiness and secure the U.S.'s reserve currency status. The U.S. banking crisis has had far-reaching consequences not only for the U.S. economy but also for the global financial system, as countries like China continue to diversify their reserves and explore alternative currencies. The U.S. will need to adapt if it wants to maintain its status as the world's reserve currency. The coming years will be crucial in determining how the U.S. responds to these challenges and whether it can maintain its position in the global financial landscape.
Thanks for watching. If you found this video helpful, please consider subscribing for more content. Take care.